Well, hi everyone, Happy New Year and welcome back. This is our first webinar for this year, 2023. I'm Tom Wilson, I'm one of the investor education and product specialists at InvestSMART, and I'm joined by our Chief Market Strategist, Evan Lucas. Hi Evan.
Happy New Year to you, Tom, mate. It's good to see you. Good to have the banter back. Look, I do apologise, everybody, that we're not in the same room. Unfortunately, it hasn't completely worked out that we're in the same location yet, but that is all right. It's been quite an incredible year, 2022, which is why we wanted to do, as you said, Tom, that today's topic is looking back to look forward. Last year, in my view, and I'll talk about this a lot, was an absolute textbook year of why you long-term invest. And I'll come to that in a minute. But guys, welcome back. It's great to have you here. Tom, mate, great to see you.
Good to see you
let's
too.
Get on with this. Let's get on with the disclaimers and stuff so we can dive right into it.
Yeah, I mean, as always, it's general product advice only, not kind of any kind of personal financial advice. So always keep that in mind. And we obviously talk about the InvestSMART products as well and different tools on our website that you can use to do in your own research. But that being said, this is what we're going to cover off today. And I know you were talking about this, Ev, just then about lessons of 2022, because it definitely was a very interesting year. We'll go through some of the ETFs that were inside the portfolios. I'll let you cover that off because that's your bread and butter. And just touch on what 2023 might bring. Talk about perhaps some of the December professional managed account numbers. But then obviously happy to take any questions. And we've got some questions that have been submitted before the webinar, which you can always do. But you can also on the right-hand side there, ask us as we go.
Yeah, and what I'd also point out before we go any further is if you've got questions now, in the right-hand side there on the box, get into them. We'd much rather cover your questions than Tom and I just sort of sit here and sort of gas bagging away, because both of us can do that quite easily. We do want you to be as interactive as easy as we can. So look, I'll let and go through with what sort of is on screen here. Main themes, volatility. And I'll be honest with you, volatility from 2022 is probably likely in 2023. I don't think you can get away from the fact that there are still big issues facing the global economy, which we are not immune from. There are still big uncertainties around how COVID plays out in China, about what's going on in Europe with the unfortunate Ukraine war, where that means for oil, all those kinds of themes that you can really hone in on. Were themes of last year, and they're going to be the themes probably, particularly in the first half of this year. And I think you need to understand this, why I say it. That's fine, because it's part and parcel with what investing comes with. Those kinds of inputs are always there. I mean, if you just want to pinpoint 2022, you can, but you can then go back to 2018, 2015, 16, 2011 and 12, GFC, so 2008 through 2009, dot-com bubble, recession 2002. I can pick all those times for you, and we do them constantly. And the reason we do them constantly is because they are time and time again events that we will go through, and last year will be, as I said, a textbook of why long-term investing works and why all of the short-term issues, all of the pessimism, because pessimism was through the roof. One of the best quotes I've ever heard around this, and I'll get to that in a minute, it comes from fantastic writer in Morgan Hassel. He talks about the idea that pessimism makes you sound like a genius, optimism makes you sound like a used car salesperson. All right, and it's a really good quote because it's true. Pessimism is a really dialing in scenario to the idea that you're being conservative, you're being thoughtful, you're being constructive with how you look at things. There's a almost like this idea that you're being constructive criticism, feedback on what you're doing, but it's actually just pessimism. And pessimism means that you miss opportunity, means that you get off what you're trying to do for the longer term, means that you miss opportunity, because the Warren Buffett term always counters that, which is that be greedy when people are fearful, be fearful when people are greedy, be fearful when people are greedy. And last year was prime fear. And that for me is the summary of that slide of the themes of last year in terms of where we are at.
Easily. And I think it even comes back to that same Warren Buffett quote. I think I use it probably a bit too much, but he talks about there's always going to be uncertainty in the markets. And that's the whole point. And there's some points there I've got, which I'll put these slides up along with the webinar once it's been edited this afternoon probably. just talking about how different markets, they've got different levels of performance along with the asset classes. Diversification, it's like a tried and true approach to try and smooth out the returns. And like lastly there, like the best performing asset classes, they vary from year to year. So one year, something that's doing very well, next year can be, you know, the worst. And we don't touch some asset classes for a number of different reasons. And one, of course, is like cryptocurrency. We stay away from that. And I guess, like, you know, 2022 was a year where we saw that have a, you know, a big fall, which will probably continue as well.
I'm going to jump in on that because obviously we just had a festive period, and it's a period where you can obviously sit down and do nothing. And I spent a lot of time over the last sort of 3 weeks just reading like lots of different little bits of pieces. And the best quote, I mean, you and I have been pretty open about our view on things like cryptocurrency. And the reason I want to go there is that we're also going to have, we've had some questions also about commodities and thematic ETFs, right? And let's look at it from that perspective. You know, you can buy a crypto ETF. The best thing I saw was a fund manager out of the States. He was and used to work for Invesco. He used to also be at Goldman Sachs. He's now got his own fund, and it's ginormous. It's about $50 billion US, and he only started it in the last 2 years during COVID. But he pointed this out better than anybody I've worked out to do this around cryptocurrency, and why he sees it as such a problem and such a risk is that when you invest, you are the creditor, right? So you're putting your money into the ETF. That ETF then goes into the underlying, you know, if it's BlackRock or Vanguard, they then go and buy the underlying equities, CBA, BHP, blah, blah. So Vanguard becomes the credit, your, you know, debitor. They pay you from going through, from the debitor being those companies. And why I say it that way is that it therefore means that as a creditor, you're getting a yield. You're getting paid for that risk that you're taking. But on somebody's balance sheet, your credit is their liability, right? And that's fair, right? So if you go to a bank and borrow money, you owe the bank money. It's the same way you're the bank as an investor in the reverse idea. Very simplistic idea. Why I say all that? What he points out with crypto, there is no liabilities. You're basically just passing around a token from people to people to people to people, because you're not actually anybody's creditor. There is no underlying asset or no underlying liability to be paid back for. And he said that's what is so dangerous about crypto, is that it's actually nothing. It's just people passing tokens around to each other for a price that's basically made up on a market. And it's the best summary I've heard about why crypto is such a random, weird asset class, why InvestSMART will never touch it, because it isn't actually a business. It isn't actually an asset like a piece of property. It isn't actually, even though we don't touch gold, it's not a piece of gold either. It's just random tokens being transferred between people.
Yeah, I mean, you're absolutely right in that respect, and we've spoken a lot about it in the previous ones. The other thing I was going to touch on, I guess, one of the biggest things we've seen this year is obviously inflation, and then interest rates being moved by the RBA to try and control that. And there's 2 points there I put is like 2nd of Feb, it was the target rate was, the cash target rate was at 0.10%, and then, you know, we saw in December it's gotten as high as 3.10%. So obviously that's having an impact on, you know, so many different asset classes. Again, house prices, which I think you were looking into this just the other day. You were speaking.
So it's now officially a record decline in Australian house prices. So it's down nationally. The house price index is down 8.4%, overtakes the decline from 2017 to 19, which was 8.38%. And it's not going to slow down anytime soon in terms of that speed. Does need to have a caveat behind it, because from the bottom of that original record from 2017 to 19 to the peak in May last year, which is where that next read comes from, that 8.4%, the Australian house price index rose by 28.9%. So put that into a bit of perspective. So again, all markets have ups and downs. All markets, you can hone into the pessimism if you want. The Australian housing market was bubbly. It was pretty high. Let's point that out there very clearly. And that's fine. It will be like all other markets. It will recover. And that needs to be there. And that chart on screen is great, Tom, because it does point out from the fact that we have seen 3 percentage points in the official cash rate. It's probable you'll get some more this year, though there is signs that that may be not happening in February. There could be a pause. I know there's been a couple of questions about that, and we'll talk about that later. So
Yeah.
the interest rates are there. Don't forget, we're not the only country to have it. The US federal funds rate went from their record low, which was also 0.1%, to where it currently sits, which is 4.25% to 4.5%. And there are Fed speakers out there saying that they think it will get to or above 5%. So just keep that in mind in terms of what's going on.
Yeah. I mean, I guess the other thing is if you wanted to even run through some of the exchange traded funds that we hold inside our portfolios at InvestSMART.
Yep. So I think this is really important, and this gets back to what we started at the start of this whole talk, which is that 2022 will be a textbook example of why listening to the politics, listening to the geopolitical issues, macro themes, blah, 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 and not having a long-term view will create mistakes. So these charts here, I deliberately wanted to use the ETFs that we think are the best at the moment. So that is, for us here in Australia, it's IOZ. We think it's on the metrics that we always use, which is the MER, so the management expense ratio, 0.4 of 1%. It's got a price that's very usable, it's highly liquid, and it replicates the underlying market really well. All of the charts I'm going to show you are total returns. It's obviously an absolute key theme of what InvestSMART talks about, which is that you must be thinking about reinvesting your dividends because it actually also offsets that. But having a look at that greeny lime line from the close of 31st of the 12th, 2021 to the close of business on the 31st of the 12th, 2022, IOZ was down 0.7 of 1%. 0.7, that's it. At one point there in December, I actually thought it might pull it off and stay in the black. It obviously had a 5% decline across the market and we fell just below it. But why I want you to highlight that, have a look at how jagged that is. Those y-axes are telling you that that's a 10% change or more. And you can see it was all over the shot last year. And it really took off as interest rate issues came about that Tom showed in his previous chart, inflation, blah, blah, blah. But if you listen to all that, you would have missed opportunity in terms of where it is. And that's why, you look at this. And if I go back, and I should have put this in as well, and apologies, Tom, I should have given it to you, but if you go back over the last 5 years, right, to the close, so from 2018 to the close of business 2022, the IOZ total return you've been given is 44.2%. And that includes all of the rubbish that's gone through there. And I've also deliberately put on here IVV, which is the S&P 500. The reason I've put that there, some of you will be invested in the international share portfolio, which is great. It's been one of our best performers. Look, I understand last year it wasn't, but again, long-term mind frame, long-term investing time frame. The 5-year return of IVV, same period as IOZ, is about 72.5%. And you've got to remember, putting in perspective 2022, last year, the S&P 500, which is that silver line, I put that there deliberately, I'll come back to this in a minute, down 18.1%. But that goes on the back of 2020 and 2021 of 2 years of above 20% returns. So last year needs to be put in massive perspective. It's probably fixing up the over exuberance of 2020 and 2021. Why I put that there, have a look at the silver line compared to IVV, which is the replica of the S&P 500 that's just there. Why is it different? And the question is there for a good reason. We get a lot of questions about why we hedge or don't hedge in terms of that there. IVV is denoted in Australian dollars. Last year, what saved a lot of the portfolios that are globally exposed was the Aussie fell. It fell from around about 72 to 73% the start of the year to as low as 62 cents. And it actually therefore meant that because IVV is US exposed, then converted to Aussie dollars, it actually gave you a benefit. So you did get a benefit. Now, the argument will come back straight away. Well, what about now when the Aussie dollar starts to tick up and blah, blah, blah? That will smooth out, right? That whole smooth out. But the reason I wanted to highlight that difference and why it matters is that the cost of hedging is really, really high. So IVV is really quite cheap on its management expense ratio. If you compare it to its hedged partner, which is about 0.8 of 1% compared to it, which is about 0.1 of 1%, that cost we think is too much to absorb. And look, it will mean sooner or later that it might work against us, and that's fine. because again, over the longer term, as I said, IVV has given you over the last 5 years 72% plus on a total returns basis. So this is what we always consider. It's why ETFs are becoming so popular. It's why we love them, because it gives you exposure to the US market, but they also, again, give you a chance to sort of get around issues that can come with individual areas and individual sectors. Final one is the VGS. It's the international equity, which is all 23 global markets excluding Australia that are rated by the MSCI. Again, they're heavily exposed to the US, and you can see it's quite closely correlated there. The reason it did better, again, currency, but also Japan did better than expected. The UK, despite all things that happened in 2022, did better than expected, offsetting things like Germany and France, which had shocking years. And so once you actually take market capital of those, put them together, that index is there. We still think it's an absolute, great way of having exposure to the international equities, because Australians are underinvested on international equities, and over the longer term, international equities have actually outperformed the ASX, and that needs to be certainly part and parcel of where you think. It's a lot of talk there. Sorry, mate.
No, that's fine, because the other part is obviously with some of the bond ETFs, obviously the Australian bond, but the global bond ETFs as well.
Yeah, and we don't want to sugarcoat this. So I deliberately wanted to put this chart here. So this is IAF, which is the Australian Bond Index. That's federal and state bonds blended across time duration. So they have the Australian government, federal government of 1, 2, 3, 5, 7, 10, etc., etc. Same with state bonds. The global bond ETF is, again, like its equity equivalent. It is a blending of all global, investment grade bonds. So it's heavily exposed to the US. Last year, it needs to be pointed out very clearly, was savage. It is abnormal. It is the kind of issue that you would see in equities, not in bonds. And it's the worst year that any of them have ever actually had on their record. So I want to put that out there very clearly. It's Liz Moran, who writes for the Eureka Report, put out a perfect quote around the global bond index, which is replicated by that Vanguard global bond ETF. Without the currency, so if we had had it in the common currency, it actually declined 20%, which was 4 times worse than its previous record. So that's how abnormal last year was. So the previous record was a 5% decline for a year. 20% is completely off the charts. And I know last year was all that we were getting was conservative and defensive, investors going, what is going on? Why am I underperforming equities? Why is this happening? Tom's already put it up partly. The increase in interest rates is part and parcel of that. The increase in inflation is part and parcel of that. The risk around inflation, it gets overdone. It needs to be pointed out there as well. However, bonds are still very much an incredibly important asset to be exposed to. They are still a very defensive asset to be exposed to, despite what happened last year. Because if you remember 2018 and 2019, I remember sitting here writing and talking about the absolute reverse. Bonds were giving you 8 to 10% appreciation. And I remember sitting there going, you should not expect that from bonds. And if you actually have a look over 5 years, it's actually now neutral. So they've actually counted themselves in terms of where they are. What's been interesting, again, doing my reading over my Christmas period and being the nerd that I am, most institutional investors actually see themselves moving down the risk curve, moving away from equities and things like that, moving towards bonds, moving towards cash. And a lot of them talk about bonds in a more optimistic and exciting way. And why I say that is that what's now happening is that, don't forget, a bond is not like cash. A bond has a capital price that's on a secondary listed market, so it can move up and down, and a yield. Everybody just gets caught up on the yield. The reason the capital price is so interesting is that at its maturity, so let's say it's a 2-year Australian bond, it will have a maturity date where the Australian government will give you back face value. In Australia, face value is 100 Australian dollars per bond. It's the same in the US, just in US dollars. It's a little bit different in some other parts of the world, but let's not go there. That's actually now trading at discounts as much as 87 Australian dollars to face value. So you're talking about $13 guaranteed to you at maturity if you hold it to maturity, and a yield that comes with it. And a lot of the bond investors are now going, well, I actually think things are going to be a little bit risky and are moving towards it. And I wanted to highlight bonds to say, I know last year was savage. I know a lot of you have questions about it. I know a lot of you are asking, is it actually worth being exposed to this asset class? The short answer is yes, without even, there is no question, because they are a defensive asset. They have been oversold. They have been done to death because of a whole range of things. And last year's performance is telling you, my lesson from last year is that 2022 will go down as one of those years that people will go, how did that happen? Why did it happen? And it's because we basically had a pushback from the COVID era of 2020 to 2022. All of the problems that were going to come with having a health crisis like we did have appeared last year. And that's the way that bonds have performed.
I guess now we can move to like what might happen in 2023, and I guess you've touched on some of these already, talking about China eventually easing their restrictions and coming back into the market themselves and opening back up for business, potential resolution, Russia-Ukraine conflict, and any other flow-on effects that might have. But there's still going to be some economic challenges that we can see in the UK, Europe, and overall disruptions to supply chains, even with energy prices. But there's always the natural disasters component, which we've seen increase in a number of years as well, which could impact higher inflation, could also impact some insurance companies, which obviously make up markets themselves.
Yeah, and so on that, what needs to be highlighted by Tom's perfect chart summary there is, again, they are issues that we know are certainly bubbling under the surface. They are issues that markets will deal with, and that's the term. It will deal with it, and it will do it in a way that will be short term, might feel very, very hard. The volatility will be up. There'll be changes, etc. But overall, when it flushes through the system, it will be a short term issue, and that's why at the moment, what's so incredible is that almost all strategists and almost all investment bank buy side, sell side are all aligned in 2023. And what I mean by that, they actually expect almost a tale of two stories. First half, tough, volatile, unknown. Second half, optimistic, good upside, really exciting period. They're all the same. And what's so weird about that is that normally when you have that such of alignment, it almost is inevitable that it comes to fruition, because everybody's thinking the same way. And don't forget, a market is just all of us doing certain things a certain way. Some of us think it's a sell, some of us think it's a buy. It's that simple, right, when you think about it. But when you're all aligned, it almost makes that scenario a certainty, because of exactly the points you've got on screen. The unknown event about China reopening so fast, having a COVID wave going through it at such a rapid number. There's some people that look at it on an optimistic side, which is that it could be over by March, and therefore China could be back up and running in April, which is normally when they get back up and running anyway in a normal calendar year. That would be interesting, because that could bring forward that optimism. What happens in Russia and the Ukraine conflict, from my perspective, reading up from what everybody else is saying, is that at the moment it's going to be a protracted, drawn-out conflict. There's a suggestion it will not get resolved in 2023, and that I think needs to be very clear, which means therefore the impact on energy prices and energy in general will remain a problem for us globally for a foreseeable future. And then the big one is the R word globally, not just the UK and Europe. It's whether or not the US hits it as well. The World Bank and the OECD have both forecasted that a third of the world will fall into recession this year. Now, that sounds doomy and gloomy, which it is, but a recession is retrospective, right? A recession is 2 quarters of negative growth. So it means it will have happened. There's only one way to go from when you're in a recession, that's up. And that's why historically, if you look at the US particularly, when they've hit recession and declared it, that normally has actually almost been the signal to be a little bit more optimistic, because 12 months from now, there will have to be changes in policy. There will have to be changes in direction. There has to be a way to continue to make sure the economy is moving and not contracting. And they're all positives in terms of where it is. So just keep that in mind as well.
Yeah, there's some good questions here that we had that were around the outlook of commodities, iron ore. An interesting question from Jerry asking what's the probability of a cash rate reduction in the 23 financial year 24?
Yeah, so I had a look at that, Jerry, before we started, because the best way to do that, you can actually go online, you can look up the 30-day interbank swap rate. It's on the ASX, you can see it. So the probability of a cash cut in FY 23-24, so I'm taking that till June next year, because we're technically in 22-23 in terms of where we sit right now. There isn't one for this financial year, but next financial year, the probability is sitting at just shy of 80%. The market actually thinks that by June 2024, the cash rate will probably be where it is now. Because what I mean by that, they actually think the cash rate will go up by another 50 basis points, so about 3.6%, but it will come back to 3.1% by June next year. So that's actually, if you argue it, you can make that's a certainty that there'll be cuts, but it's not an absolute lock in terms of into it, because it's actually in July and August that they think that will happen.
Yes, yep.
So yeah, I wouldn't necessarily watch too heavily on that. Why I say that is that, again, central banks have this incredible habit at the moment to talk rather than to act. And I think that needs, I mean, they've acted of late, but historically they talk more than they act. And that's why some people are suggesting that maybe we're actually already at the peak and central banks might threaten to raise rates further, but might not do it. And that would be an argument, inverted commas, of actually being that cut, because it's not going to get as high as what people are thinking it's going to get to.
And just going back, I guess, to some of the commodities questions like iron ore, oil, rare earth metals that Glenn's talking about, how the market seems obsessed. I mean, it's something that we often find a bit conflicting at InvestSMART, because we don't really drill down into that minute detail and focus on such, I guess, short-term commodity prices. We have like passive invested portfolios where we are exposed to different markets. We sit back and we accept the market return. That'd be more of like a thematic type ETF approach, which on our website there actually are some filter tools that you can search for exchange traded funds that give you that exposure. But it's something that we're much more longer term. We believe that a diversified portfolio that matches your time frame is the way to go. So we don't get stuck in that minute detail. But you know, if you've got more on that, Ev, definitely.
So my 2 cents on that would be, the other way to look at it is exactly that. So you can certainly look at them through thematics. You can certainly look at it as maybe it's like a satellite in your portfolio. We talk about a core and satellite perspective in terms of how you can invest, and having small exposures by all means. Being aware that when it's a theme, like that's what thematic's for, when it's a theme, you've got to be understanding the underlying rationale. So the question that came from Glenn, which was around the obsession with rare earths, it's the thematic idea that the demand for those products is only going to increase. So obviously rare earths are very, very prominent in your mobile phones and in computers, etc., for the screens that you currently are using. It's also around things like lithium and the fact that batteries and the future of batteries. You've got to understand that, and that's why there is a bit of a craze, a bit of a mania, I think is possibly the words around it. And that's fine. I mean, again, if that's what you want to do, we do not want to, the word isn't stop. We just want you to be informed. And as long as you're fully informed about what that means, by all means, and as Tom's showing on screen, we've got our ETF finder. You can go and look it up. There's heaps of them out there. And if you think rare earths or lithium or whatever it is something that you want to be involved with, if you've done your research and you understand the risks, then by all means go and find it, and you can find it from there.
Yeah, there's definitely the tools on the website. There's also filter tools for managed funds, some hybrids, other things like that. So definitely use that to your heart's content. And of course, we've got our own investment portfolios up here that are diversified. And also the single asset class that you touched on, especially with the international equities. It might be a good time, because there's still a couple other questions we've got that are talking about the portfolios. So why don't we have a look at, I know that we don't have it published yet.
I'm busily working through that right now.
Yeah, the December PMA numbers. the ASX 200 itself, which we tend to like refer to get an idea, it itself was down 3.21% for December. And we do publish these reports. If you go to the product pages for each of the portfolios, we do put them under key facts, latest reports. So I don't know if you wanted to touch on this.
So yeah, I was going to say, because I'm currently working through the quarterlies in terms of what it is. So the end of December obviously was the end of the final quarter of the calendar year. I've worked, again, as you can hear through what we've been talking about in this webinar, we try and talk longer term. So the quarterlies I've deliberately done as on a year basis as well. I've put in quarterly data, but I'm trying to get away from thinking short term. I'm trying to get away from telling you what's happened by quarter, definitely week by week or month by month. I want to get away from that. I want to talk to you about what's happened over the year. So they're coming. So that will be there as you know, Tom's got there, that button on the right-hand side, the latest reports, we'll have that in there. It should be out next week. It does take a bit of time, unfortunately, in the last quarter because a lot of the ETF providers, also like us, go on holidays. So the data isn't there yet. So we're just waiting on that to get it through to you. We are not sugarcoating last year. It was a tough year. We know it was a tough year. We want to point it out very clearly, though, that it was actually the first time in 4 years that the portfolios have actually declined over the calendar year. Even in 2022, the diversification offset the issues that the ASX specifically had because international equities gave you a return, bonds were flat, cash gave you a little bit, property was flat. So when you look at the diversification, even 2022 was a year that you got a slight return from calendar year. Last year it wasn't, and again, nobody got a calendar year return. If you listen, all the super funds are telling you that at the moment. It's the first time in a long time the super funds have actually seen a decline in their overall returns. It's part and parcel with investing. We are giving you the market for a reason. We think the market will give you the best return over the longer term, being 10 years or more, and that's why we do what we do. So last year needs to be put in perspective that yes, it was difficult. Yes, short term, it can certainly change your strategy. But if you, again, I'm just going to do the normal stats that I love doing. The average return over the last 10 years of the ASX, including 2022, is 8.2% on a total returns basis. So it's dropped a little bit. It was 9.3% the year before. So think about that. If you look at the S&P 500, it's still averaging over the last period, same time, over 10.5%. Now, last year really hurt it because the year before that, it actually jumped up to 14%. Unrealistic. So that needs to be pointed out very clearly. So those are the things we keep thinking about. It's what we always do when we do what we're doing. What is the long-term average return of the market? It is this. Is that better than peers in terms of those that do active, etc.? Yes, it is. Therefore, that's why we do what we do.
So I guess now it's a good opportunity. If you've got questions, definitely ask them on the right-hand side. There's one here from Severa that I'm going to touch on, and she's saying, or they're saying, sorry, I noticed that during the year there were some changes made by the fund manager in my portfolio. Is that correct? If so, why? And that usually is referring to rebalancing. And what I'll do is I'll quickly show you just on the website how to access this information. So obviously I'll show you, just say if you're in the balanced portfolio, and you can see that we're quite transparent when it comes to under key facts. You can see the asset allocation here. It's all different percentages. And then what we actually hold on the right-hand side. We obviously want to follow the benchmark. So we need to stay in line with that. So during the year, there might be occasions where there will be adjustments to it. And in the help center at the top right-hand side, for those of you who are thinking about investing, there's the I'm considering with InvestSMART, but also the I'm invested in InvestSMART part. We talk about so many different answers inside here, but there's one here that will answer your question, Severa. When does InvestSMART rebalance a portfolio? And it literally goes through a number of different reasons there. The other thing, Evan, this is something that we had a question that came to us via email, talking about how for some people, the returns, they don't seem to match the published returns sometimes. And there is an answer here saying why portfolio returns can differ from the investment model returns. Did you want to touch on that as well?
So yeah, so I mean, again, I don't. The response that we've got on the website is obviously what you and I have gone through many times. It's refined perfectly to sort of get there. But as you can see, it's when you start, right? So again, if I'm talking about the calendar year for 2022, I'm making an assumption there that you invested on the first day of the calendar year 2022 to the end of last year. So that's your inception date will be varied across all of you. Some of you will have got in 5 years ago. Some of you might be brand new. Some of you might be all in between. So that will mean that your response and your return will be different in terms of what it is. On the website, on your portfolio page, there is a chart, right, that will show you from inception you started to where you are in any other point. You can move it back and forward all you want to give you the exact number for you personally. We can't speak to every individual person, so that needs to be pointed out there. The other one there is income sweep. I do want to highlight that as well. That's really important.
Yes.
Some people are on a retirement scheme or on an income stream where they actually therefore are being paid a return from dividends, etc. It might be monthly, it might be quarterly, it might be whenever distributions are done. Again, everybody's different on that. That too will mean that you'll have a different number. If you're not doing total returns, which is fine, again, I need to point that out very clearly. I know I'm very strong on it, but if you're not, that's fine. But it will therefore mean that you're different. You won't get as big a return because if you're not dividend reinvesting or your distribution reinvesting, you are going to have a lesser return, you're going to have less of exposure, etc. So those are there as well, adjusting and changing it in our investment models. Some models get readjusted more than others. The reason for it, let's take the international equities portfolio, for example. Let's say the US market, like last year, where it fell harder than some, but it still needs to make sure that it is the 60% weighting that it is the global market. We may have had to do some adjustments to keep it at that level, and therefore we may have been buying a little bit more than usual, and therefore the drawdowns are higher. So all of those are little reasons individually that can add up to the difference that you're talking about. And everybody will have experienced different things depending on what they're invested in those asset classes, whether it's the diversified or single asset. It will also be different in terms of the size to do it as well. So all of those are there in terms of that space.
And lastly, there's a question from Jeevan, which we had, and they're asking how to go about with exchange traded funds or diversify with exchange traded funds or mutual funds for regular below $1,000 investments on a regular monthly period. So I'll quickly touch base. There's obviously the InvestSMART diversified portfolios we offer. So they're like an off-the-shelf option. They require a $10,000 minimum investment. So you can come to us with $10,000 and we'll get you diversified across different asset classes. So they range from conservative, balance, and you can see the time frames here as well. Very important to match those with your time frame. There's also an ethical growth. The other option that's become very popular is there's a new way to enter these. It's called Fund Later, and you can go up to the top of the website, Fund Later, and you can actually come to us with $4,000 instead of the $10,000, and we loan you a non-recourse loan of the $6,000, so it makes up the $10,000. Then over a period of 20 months, you just make 20 fixed monthly repayments of $325. So there's no interest, but inside that $325, it's a $25 facility fee to have this set up. And once you've paid that back over the 20 payments, the entire investment is yours. And during obviously these are long-term investments. We have 3 of them available with Fund Later. But during the period, if you decide not to go ahead with it, you can walk away from the investment. But obviously, do sort of factor in the fact that it is a longer term investment. The only other question I can see here, Evan, is that there's one from John just talking about diversified equity and infrastructure funds have worked well historically. Are we in a new game requiring narrower investment?
Yeah, and there was also a question from Leon that came on email this morning that was something fairly similar. So it was about the ethical growth underperformance. It was also about the property infrastructure underperformance. I'm going to tackle the ethical growth question from Leon first. The reason for that is that last year, if you compare the ethical growth to the growth, The reason it's underperformed the overall market is its non-exposure to resources and energy. I mean, last year, you need to remember that energy was up 33% in that space. Commodities overall was up around about 12.5%. Now it fell in the second half of the year, but overall that difference in the equity ethical growth to the growth was because of its ethical overlay of not having exposure to commodities, not having exposure to environmental issues. That was for last year. Again, that's a short-term thing to look at. That will probably reverse in the future. There's no doubt we're moving away from energy that is fossil fuels. We're moving away from using that. The longer-term view is that, that outperformance of 1 year will be smoothed out. So understand your concern around the ethical growth. It is something we're aware of. All ethical funds last year underperformed non-ethical, if that's what you want to call them, portfolios because of that movement that we saw in that underlying commodity space. Property infrastructure, we've probably said this enough, and I will just say it very quickly. They are the most exposed to debt funding. So increases in interest rates are going to hit that industries much, much harder than anything else because they are big capital requirements. They are big asset investments. Therefore, you normally have to do that with some form of debt. And that is what has happened last year. Property infrastructure was savage for that reason. And that is part and parcel, unfortunately, of having an exposure to a risk like interest rates. And there's no more explanation, unfortunately, than that for both the question that came in early and then also from Leon that came in this morning, is that you can't really get past from that, unfortunately. And that's just the way and where we are at in the cycle that, doing and building infrastructure projects is, as I said, huge. If you're building rail, if you are building airports, if you are building roads, they're expensive assets. They're great returns when they work, but again, you've got an exposure to a debt product. It's the same with infrastructure. If you're a commercial infrastructure provider, property provider, yields haven't been great because rental returns haven't been there as good in the post-COVID world, and interest rates are up. So that's the simplest way I can answer it for you. I understand that it's been tough, but that unfortunately is in part and parcel of the exposure you have in those specific sectors. It gets back to also what we talked about before about thematics. Being aware, having a themed idea means that your risk gets much more concentrated, and that just needs to be part and parcel of your thought.
And there's a good article, actually, one of our contributors, Phil Bish, has written, thematic ETFs, are they worth the punt? Definitely have a read of that. And the other free resources that are on the website. We've got Bootcamp, of course, at the top, which we try and help everyone learn more about investing, about the long-term nature. And Evan, you often write for Eureka Report, amongst other news outlets as well.
Yep.
The other thing is we try and put a lot of info in our help center so that you can go there and read through everything we've got and try and get an answer. But we've also got the little chat box on the right hand side, so you can always ask us a question when we're working 9 to 5 Sydney Melbourne time, Monday to Friday. But you can always send us an email also, and I'll just get to that last slide, so it's all written there as well. So help center, email us, or use our online chat. But we don't have any other questions, so Evan, I guess we'll leave it there, and thanks so much again, and we'll be back next month for the next webinar.
We will indeed. And guys, thank you as always for joining us. It's been a long one, I know, I do apologize that, but we do have a lot to cover off. It's been a big year. Look forward to seeing you throughout the year and talk to you soon.